Sell-side liquidity are resting sell stops below old lows and equal lows. The algorithm targets these pools to fill orders, so they help guide you on where price is likely being drawn. Buy-side liquidity, resting buy stops above old highs and equal highs. It matters for the same reason as the sell-side liquidity. The algorithm targets these pools in order to fill orders. It helps show you where price is likely to move next. A liquidity sweep. A quick run beyond a high or low to grab the resting liquidity, then a reversal. This matters because it distinguishes a real breakout from a stop hunt and often marks the actual turning point of a move. Power of Three, or AMD, accumulation, manipulation, distribution. Accumulation, manipulation, distribution. Within a single candle or session, price builds a base, fakes one direction, then expands the other way. This matters because it explains the anatomy of opens, daily, weekly, and helps you avoid getting trapped in the manipulation leg. Kill zones are high probability time windows for setups. This matters because liquidity and volatility concentrate here, so trading these windows improves setup quality and filters out dead time. The 50% encroachment is the midpoint of many different things on a chart. It can be a range, it can be a candle, it can be a fair value gap or an inverted fair value gap. This matters because price often respects the 50% line of an imbalance, so it's a refined entry or an invalidation marker rather than using the whole gap itself. A fair value gap is a 3-candle imbalance where the wicks of candle 1 and candle 3 don't overlap, leaving a gap in the middle. This matters because it marks inefficient price delivery the market tends to revisit, giving you precise entry zones. I made videos explaining which ones of these fair value gaps are relevant, so feel free to watch that later. An inversion fair value gap is a fair value gap that gets traded through and then flips polarity. A bullish fair value gap that fails becomes resistance, a bearish one that fails becomes support. This matters because it confirms a shift in order flow and turns a failed level into a high probability entry. Many people have made millions of dollars off of inverted fair value gaps alone. An order block is the last opposing candle before an impulsive move, marking where institutions have placed orders. This matters because it acts as a high probability support or resistance zone on the retrace, giving clean entries with defined risk. If there are multiple candles prior to the move, I will oftentimes use both of them or all of them to form the order block, although technically it is simply the last candle prior to the move up. A breaker block is a failed order block. When an order block gets violated, the last opposing candle cluster becomes a breaker that price retests. This matters because it signals structure is broken and gives a continuation entry in the new direction. Premium discount. You can split any range or leg at its 50% or its equilibrium. Above the midpoint is premium, below is discount. This matters because you sell in a premium and buy in a discount. So it keeps you on the right side of value instead of buying highs and selling lows. Every entry zone carries more weight when it lines up with the correct side of the range. Displacement is a strong, aggressive move that leaves an imbalance behind. This matters because it's the footprint of institutional intent and validates a fair value gap or structure break as legit rather than just noise. Internal versus external range liquidity, or IRL, ERL. External is liquidity at range highs and range lows. Internal are the fair value gaps and order blocks inside the range. This matters because price oscillates between the two of these. It goes from external range liquidity to internal range liquidity. New week opening gap, or NWOG, is the gap between Friday's close and Sunday's open. This matters because it acts as a long-running support resistance reference and a draw target all week, and an area where price tends to go back to, aka a target. Swing highs and swing lows are pivot points on a chart. A swing high is a candle whose high is higher than the candles on either side of it. A swing low is the opposite. As you can see here, the low of this candle is lower than the one to the right of it and to the left of it. So this was the first protected or swing low that existed. As you can see, we broke up and we get once again a low that has higher lows on either side of it. This now becomes the new swing low or protected low, and this one is no longer. This matters because they're reference points that define structure. Every change in the state of delivery is measured against a swing point, or a protected swing high or swing low. They oftentimes will be sitting right where the liquidity rests, so they double as both your structure map and liquidity targets. This isn't so much of an ICT concept as much as just really a helpful thing to understand, which is the time-based ranges. These time frames tend to pair well with each other, although I did create a video on how to use all of them. But generally, when you're doing top-down analysis, if you're starting at the daily, you could then move down to the hourly for an entry. The 4-hour pairs well with the 15, the 30-minute pairs well with the 3-minute, the 15-minute pairs well with the 1-minute. So technically, a great top-down analysis could start on the daily, you could then go down to the hourly, and then you could go down to the 5-minute for your entry. When I first started learning ICT strategies, I felt like I was drowning with the amount of terms and acronyms that there were. What I found out over the years that really there was only about a handful of them that I needed personally to be a profitable trader, so I decided to share those ones with you today. Things like the IPTA ranges, the central bank dealing range, were completely unnecessary for me to even understand. And trading is one of the only professions in which the more you know can actually hurt you. And that was confirmed when I had realized that the overwhelming majority of ICT strategies are just noise. You don't need to understand what the mean threshold or the consequent encroachment is. Both of those things are just 50% of either an order block or a fair value gap. What you could instead understand is simply the 50% of anything is generally important. The 50% of a candle, the 50% of a range, the 50% of an order block or a fair value gap or an inverted fair value gap. You don't need to understand a different word for each one of those things. Or change of character, break of structure, market structure shifts. Those are all basically explaining the same thing. I choose to use CISD, or change in the state of delivery. But once I understood liquidity, how it moved, so external range with internal range, liquidity sweeps with the displacement candle or the change in the state of delivery, marking the actual reversal, those are the things that mattered most to me. And when I only need to understand a handful of terms instead of 100, it's going to make every single one of my trades easier. So these ICT concepts that I taught you today are precisely the only things in which you need to know to become a profitable trader. Can you understand and learn the other ones? Sure, if you want to, but by no means is that necessary. If any of this today helped you, please consider liking and subscribing. Thank you very much.